This real estate crisis is different. Let's have a look. Hello everyone, Florian.Heise here, and welcome to another episode of HeiseSays. Let's grab a stein of coffee and have a look at this article from the Financial Review, because it discusses why this real estate crisis is different to the GFC. Now, I thought that's quite interesting. Now, Australia has been saved. Well, we were saved by the GFC for one main reason, and I'm just looking over here to bring up a website, the Observatory of Economic Complexity, one of my favorites. And, well, the main reason why we were saved by the GFC wasn't the brilliant intervention by Rudd into the building education revolution. Why does that screen always keep popping up? Building education revolution. As you can see, our drastic increase in education quality. Yeah. A lot of those projects were just, well, let's just say a lot of schools got things they probably didn't need. Yeah, which were a few perks, but haven't resulted in a better outcome. It was because our nation has a trade partner that demanded a lot of our resources, because, well, one of the ways for them to deal with the GFC was massive government stimulus. And that's China, 35.5% of our resources. Coal, iron ore, gold, petroleum are all things that we export. Australia's a quarry. Australia is a quarry, guys. Nothing wrong with that. We just have to understand it when we compare ourselves to other countries around the world. So, why this real estate crisis is different. Real estate crises happen with regularity, but they are not all the same, nor are they equally severe. Today's crisis is a crisis of income. A decade ago, the global financial crisis was a crisis of capital, which means that those waiting for a GFC-style property collapse, when Goodman Group stock changed hands at the equivalent of $1.25 a security in May 2009, are like generals preparing to fight the last war. During the GFC, there was no money. Both equity and debt were severely rationed and priced accordingly. In fact, the banks wanted their debt back. Today, there is plenty of equity and debt. The real question is about the sustainability of income. Current income is under scrutiny as never before. How the big question for RE real estate investment trusts analysts at last month's results was, how much rent did you actually collect? And that's what we've been discussing in several articles, just looking at the retail sector. Since the beginning of the year, it felt like it was another retail business going under, left, right, center. Now the question is, with us working from home, with us getting more used to online purchasing, will the returns that these real estate investment trusts, either those in the retail sector, in the office sector, or in the government sector, will they still be there? Will they still materialize? Will they still be able to get those 4% yearly rent increases, which is just for no work? At the same time, the pandemic is forcing investors to confront the structural changes that affect future income. How much rent can retail tenants selling discretionary items actually pay? What increased incentives and capital expenditure will have to be paid? Will office tenants, buffered by recession and with more staff working from home, continue to pay the rent they have been paying for CDB towers? Today, investors with money can, and increasingly will, price those risks in a way that they could not in the GFC. The Dexus Wholesale Property Fund has just sold the 452 Flinders Street Tower in Melbourne for more than $450 million in what is a global benchmark deal, some 11% above current book value and at a yield of under 5%. So an unloved sector. The buyer, the German heavyweight Decker Immobilien, advised once again by Richard Butler's team at Cushman & Wakefield, priced in the full occupancy, the large number of government tenants, the relatively long weighted average lease expiry of more than 6 years, and the advantages of buying a tower next to one already owned. So, here's a few things to consider. The relatively long weighted average lease expiry. Now, with commercial properties, with retail properties, with these type of big deals, it's the number of tenants that they have in there that affects the valuation of the property. I didn't realize that when I was agreeing to extend a lease on a retail property, that I was actually adding value to their asset. I would have been a bit more demanding in what perks I got. But live and learn. So also in the midst of the pandemic, Stockland sold 2 shopping centres, Stockland The Pines in Victoria and Stockland Caloundra on the Sunshine Coast, for more than $250 million on a yield of about 7% through JLL. Such properties are in an unloved sector, and the price was substantially discounted to $329.8 million, at which the 2 were valued in June 2018. Nevertheless, Stockland found a buyer, the Sydney-based Haben Property Fund, which has a track record in this sector and for whom the properties represent large convenience retail centres with strong performing discounts departments and on large parcels of land with mixed-use development opportunities. Importantly, Haben is backed in the purchase by equity from sophisticated investors who had the money to price the risk against a pretty attractive gearing initial yield of around 8%. In one way, the first month of the pandemic were like the GFC. The volume of commercial property sales around the world in the June quarter was half that of 2019, according to a commercial transaction research house, Real Capital Analytics. In fact, the June quarter was the worst 3 months for sales since the nadir of the GFC in 2009. Not surprisingly, hotel sales suffered the most, down 80%, and retail down 60% compared with 2019. Even the keenly sought logistics and warehouse sector dropped by 34%. But Real Capital Analytics, in its August report, Capital Trends Global Quarter 2 20, saw some positives for the rest of 2020. Many major economies are reopening as lockdown restrictions are easing, albeit at varying speeds. There are signs that the number of deals taking place is starting to creep up and capital rising remains robust. Today's graph from JLL's Head of Research in Australia, Andrew Ballantyre, points to the technical differences between the GFC and the COVID-19 crisis. Interest rates are so much lower than a decade ago. The BBB corporate bond yield, which he uses as a proxy for property funding, is now in the low twos compared to double digits in 2009. And the spread between property yields and finance costs are so much higher. In this case, the spread between the national CBD office yield and the inflation index bond rate is about 130 basis points higher than in 2007. He has also looked to Japan for guidance as to what happens to property yields in a crisis when the risk-free rate approaches zero. The answer, based on the Tokyo office tower experience during the GFC, is that yields stay firm and don't weaken in such an environment. However, he warns that secondary property will see yields retreat, as is always the case in a crisis. JLL has also surveyed investment leaders across the region about their challenges and intentions in a report titled Reimaging Asia-Pacific Investment Strategies, released last month. Lack of capital is clearly not an issue. Instead, the biggest challenge is correctly pricing future acquisitions and determining assumptions such as vacancy rates and future rents. The leaders expect better investment volumes in 2021, but lower returns and more exposure to logistics, multifamily and alternative investments, coupled with less exposure to retail. In a similar vein, Cushman & Wakefield has noted 5 key focuses for investors: to work with lenders to maintain debt levels and provide ammunition for new opportunities to safeguard existing portfolio occupancy, to accelerate development in logistics and warehousing, to seek sales and leaseback opportunities, and to keep a focus on any price softening for pre-distressed assets where owners need to rebalance. Many of those issues will be discussed next Tuesday at the Australian Financial Review Property Summit 2020. One keynote speaker, Charter Hall Group executive David Harrison, is leading the way on sales and leaseback opportunities, striking deals with Telstra, Ampol, Visy, and BP since the arrival of the pandemic. Governments, education facilities, corporates are all going to pursue further sales and leasebacks so they can invest the capital in the operating businesses that they are actually set up to provide, he said. Well, there you have it, everyone. An interesting take why this is different to the GFC, particularly with regards to retail and commercial property. Is the smart money taking advantage of this situation to snap up some bargains? Let me know your thoughts and opinions in the comments below. Thanks for watching, guys. Please like, share, and subscribe to the channel. If you're a fan and want to support the content I created, there are a few ways you can. You can join us on YouTube or Patreon. You can support us using our affiliate links at Amazon, eBay, Independent Reserve, or Kucoin. You can buy merch from HeiseSays, use Gold Pass from the Perth Mint, or support us via PayPal. Take care. Have a great day. I'll see you next time.